All right. Well, if you took my advice and worked through all these problems today in Excel, it's about to pay off for you. First of all, hopefully, as you work through these T accounts, it was helpful to have the calculation of the ending balance auto update as you type the numbers in. So if you make a mistake, it's a lot easier to fix a number rather than going back to pencil and paper and calculators to work that out. But as we proceed to the next page, we can continue to check your work. Let's go to trial balance the worksheet. Now, historically, trial balances were used for an accountant to check their work to ensure that total debits during the period equaled total credits. Today, software essentially enforces that equality, but the principle remains that at the end of the period, it's still important for accountants to check over all of these ending balances, see if they're reasonable, and go back and see if there are any errors. Hopefully, you do have total debits and credits of 9,000. If not, maybe it's worth your time to go back and see where you perhaps made a mistake. But the last task that I want to work on today is practicing your skill in classifying temporary versus permanent accounts. Um, this should be pretty straightforward. Go through column E and type in an X whenever you think a given account is temporary. You should get some pretty immediate feedback from the conditional formatting I've plugged in. But go ahead and pause your video now, work through that, and then we'll wrap up together. It's important to remember that permanent accounts are those that you find on the balance sheet. Wherever they landed at the end of a period is where they're going to start and roll over to the beginning balance of the next. So temporary accounts, on the other hand, they get closed to retained earnings. Nearly all of them are going to show up on the income statement. So these would include revenues and gains, expenses and losses. They're all temporary accounts. We didn't have gains or losses in today's kind of more straightforward example, but we did have sales revenue, salaries expense, and let's not forget about cost of goods sold, the expense associated with the sale of inventory. The other category of temporary accounts to keep in mind is dividends. Now, dividends, they do not factor into the calculation of net income, but they are period specific, and as distributions back to owners, they decrease owner's equity by decreasing retained earnings. There's just a couple others I wanted to point out here. First, sometimes prepaid expense accounts, they have the word expense in their name. This could have just as easily been titled prepaid rent expense. So it would be important for you to recognize that they're still asset permanent accounts. So if we type that in, you'd see, oh, that's not one. Similarly, deferred revenue. It has the word revenue in its name, but it is still technically a liability account. These are revenues that we have not yet earned. So they are also a permanent account. All right, well, that's great work for today. When we meet in class, we're going to start with a trial balance very much like this, and then work towards finishing off the accounting cycle, doing all the other steps necessary at the end of the period.